This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 242, and this week we dive into personal finance, which is something we've not spent a ton of time on as a specific subject. And this week we had a great guest join us from the Globe and Mail, which is Canada's national newspaper. We actually had the personal finance writer from the Globe, Erica Alini, join us. And you might recognize her name. We reviewed quickly her book, Money Like You Mean It, Personal Finance Tactics for the Real World, as part of our top book recommendations in November for Financial Literacy Month. So that was back on episode 227. So I thought Erica was a terrific guest, terrific amount of experience communicating with people about personal finance, and that imparts a lot of information in her about what's really going on the ground with things about credit and credit scores and debt and investing in general and managing money as a couple.
Yeah, Erica has experience as a journalist. She started out in economics as an economics journalism at the Wall Street Journal right after the financial crisis. That's kind of where she started. In terms of the timing of her start, it's just an interesting experience to have.
True.
And then she was with Global News here in Canada for a while, quite a while, and then with now the Globe and Mail. But she has a very interesting breadth of experience in writing about economics and finance. Her personal finance audience is quite different from our audience. So she's used to communicating a lot of these ideas in a way that is different than we would typically communicate them. Okay. And I think that gives her a very unique to our audience perspective and approach to all of this. So in addition to this being on personal finance topics that we don't tend to cover too extensively, I think Erica also has a different way from us of communicating a lot of these ideas. So overall, I thought it was a very nice conversation.
Absolutely. All right. So with that, let's go to our conversation with Erica Alini.
Erica Alini, welcome to the Rational Reminder Podcast.
Hi, thanks for having me.
So Erica, to start off, why do you think Canadians have so much household debt?
So I think, there's a tendency in personal finance, and a lot of personal finance, I think, to boil everything down to individual choices. And in my book, I really wanted to push against that because I think there are a number of macro trends that can very well explain why household debt has exploded the way it has, right? Like right now, we owe some like $2.8 trillion, which is pretty much equivalent to the value of our GDP. So that's really mind-boggling. And so what happened? And so what I argue in the book is like, it's not like someone put something in the water and we all suddenly became, spend more than you make, brainless zombies, right? There's some major changes that happened that pushed us as a society towards taking on a lot of debt. And so I argue, one of them, of course, is interest rates, which have gone up a lot over the past year, but they have been very, very low for a very long time. And so, that made debt cheaper than it had been, for previous generations. At the same time, and, obviously, low interest rates went hand in hand with low and stable inflation, again, for a very long time, pretty much until I started to write this section of the book. that held true. And that was a very good thing. But there were a few things that, when you talk about prices, that really shot up, and that's housing. And then I would also point out tuition, the cost of higher education. Neither of those are really sort of discretionary spending, that people can do without. So that also explains the rise, the need for people to take on a lot of debt. And also there's sort of financial and technological innovation. borrowing didn't just get cheaper, it also became easier. So we had, credit cards became really, really popular. Starting in the 1980s and on, the number of credit cards in circulations exploded. And then, now we can pay with our phone. There's the new version of buy now, pay later. There's all kinds of innovations that make it easier to take on debt. And so this is not to say that personal agency no longer is an issue. Of course, it's not inevitable to end up with unmanageable levels of debt, but it is that much easier for people to fall into a debt trap that they're going to struggle to get out of.
So you mentioned the debt trap. What strategies can people use to avoid falling into that trap?
So I think psychology and relying on some of what sort of behavioral economics has taught us really helps, because you basically, like, the whole argument of the book is you're trying to, when you're managing your personal finance these days, like, work against these like larger trends that are often trying to push you in the wrong direction. And so if you're trying to push back, I am very skeptical of relying on willpower. I think, I don't trust willpower very much. So I really like the argument that, some personal, the behavioral economists, Dan Ariely and such, make, that it's like, try to make good choices as easy as possible for you. And so how do you do that? Like, so part of it is, when I go through the book, is like, you have to know yourself and you have to know your debt. And so the knowing yourself part is understand how the human brain works, and then try to structure things so that saving becomes easier, and so that it becomes easier for you to stay on track and pursue the financial goals that you've set yourself. So the first step is obviously to set those goals. Like, it's very hard to save when you're not clear on what you're saving for. That's, far from enough, especially when you have very ambitious goals. Maybe you're trying to get out of a lot of debt and it will take you a while. It's really helpful to take those goals and cut them up into smaller, more manageable targets. So set yourself intermediate targets so that you can because it's easier to stay motivated if you have the target in sight, if it seems doable, and then you achieve it and it's a small victory. And you've done that, and then you can move on to the next target. So maybe, if you have a lot of credit card debt and, looks like it will take you many months, maybe more than a year to get out of it, set yourself a monthly goal. And then that really helps you stay on track and track your progress and feel like you're accomplishing something. And then I would say it's very important, obviously, to get a handle on your inflows and outflows, the good old fashioned, budgeting. It doesn't have to happen necessarily with a budget, but it's an essential stepping stone. You really have to have a handle on that. But there are many ways to, there are several methods for doing that. And I've found, like, in years of reporting on personal finance, that it really is a matter of personality often, what method works best for you. For example, like I said, spreadsheets work very well for a lot of people. A lot of people, like my dad, love to track every cent, and they thrive on that kind of discipline. And then there's a lot of people who they start budgeting with too many categories. They don't have the time, that they're not disciplined enough. And I'm in that category. I just don't even have enough time. So find a method that works for you. Get, really, like, figure out how much you can spend, how much you can set aside on a sustainable basis. And then, you got your goals, your intermediate goals, set things on sort of automatic pilot as much as you can. So auto deposits into your savings accounts, auto deposit to your debt payments, automate as much of your bills as you can. And, and that takes away sort of the, the brain, you make a one-time good decision to set up those payments, and you don't have to make that decision over and over again.
Exactly.
Yeah, that's good advice. What do you think about, you mentioned it, and you also mentioned that it's personal, but what do you think in general about budgeting as a tool to manage spending?
So I feel like it's been interesting because for a while, personal finance goes through trends, right? You guys know this, right? And so there was a phase in which everybody was against budgets. Budgets are awful. And I find, like, yes, they're awful for some people, but they're not awful in general, like I said. But if you find that budgeting, again, the old-fashioned way, doesn't work for you, another system that has become very popular, and that's the one that I use, and that, generally people who don't like budgeting do well with this other system. It doesn't really have a name. I didn't invent it, but I call it the money bucket system. And that consists of sort of assigning your different bank or investment accounts to fixed expenses, to long-term savings, short-term savings, and emergency fund. So most of us do some version of this anyways. So, people will have definitely accounts for some of their long-term savings, right? Like that we're talking about TFSA, RSP, RESP if you're saving for kids' education. And then they will have a checking account and a savings account. I think that's a pretty basic common setup. And so this system brings it a step further and it says, okay, no, let's also have, you may want to have, for example, a different checking account that you use just for paying your bills, so that whatever is left is kind of like your discretionary spending for the month, or variable spending for the month. In addition to that, I find it's super useful to have, again, emergency funds in cash set up in another account. I actually have two, because I like to have one emergency fund for the mother of all emergencies, which would be unemployment, mine, my husband's, whatever. And then I like to have a separate account for house emergencies. I feel like renters don't necessarily need this, but if you own a house, again, that's a shocker for every first-time home buyer, just how much money goes down the drain in house repairs that come up all the time, no matter how new your house is. So I like to have both. And then you basically have different you can use savings accounts for, short-term savings, like maybe a home renovation, maybe a vacation, and then irregular expenses, which are really what trip up a lot of people trying to budget. So things that come up seasonally, for example, summer camps, or it could be during the year, your kids' extracurricular activities, or it can be Christmas. And so you set up these various accounts. This method requires kind of having a sense of what kind of expenses are going to come up for you throughout the year. So it can be a bit of a work in progress, but if you sort of are pretty established in your lifestyle, then every year is going to start to look pretty similar to the previous one. And then you can anticipate this irregular expenses, and you can, it's like, okay, so I'm going to need, I don't know, $2,500, which is shocking for summer camps for my kids. And so maybe I start saving, in the fall, and I have X many months, and I need to have that money by a certain date. And then you automate your savings. And so this way, you don't need a budget, you don't need to track cents, but you're channeling your money and you're achieving your savings goals, and you're managing unexpected expenses and irregular expenses, which are usually what trip people up using budgets.
So you mentioned your husband. How does this bucketing model change for a couple as opposed to for an individual?
The money bucket system can work very well also for two people. In the book, I have a chart called the money bucket for two. And so what you do, because this is also something that people really struggle with, is budgeting as a couple. So this can work very well. It can be a mix of joint and individual accounts. So usually, obviously your TFSA and RSP will be individual accounts. And then you can have joint accounts for handling the fixed expenses. So maybe your paycheck lands in your own personal account, and then whatever share you contribute to fixed expenses, you move automatically into the joint account from which your bills are paid. And then you can contribute to, the various joint savings goals that you have by channeling money from your own checking account through these various accounts that you've set up. And I should add, because sometimes people, it feels like it's daunting, like you have to have so many accounts. So how do you do it? So for me, it's not like I usually relabel, for example, a certain account. Like, for example, once I'm done saving, usually for summer camps, I will change the name and call it Christmas spending. And so, and then I change it back. So it's not, that trims the amount of accounts that I have. But this method can get really expensive if you're, for example, if you're working with a big bank that will charge you just for having an account open. But there's an easy way to get around it. There's all kinds of competitive credit unions and online only banks that will have no fee accounts. And another thing that's very important, unlimited free Interact transfers, which is what I use. I rely on 3 institutions for, one is just sort of my long-term emergency, which I don't really touch. So I kind of like managed with 2 banks, and when I have to move funds, I just interact to myself. And then I choose which bank I want to put the money into, and it costs me nothing. So,
how do you think couples who may not have the same incomes should share expenses?
So that's a really tricky, thorny question. And a lot of couples, I find, start with sharing everything 50-50 and then stick with it. And a lot of the times that becomes a problem. It can become a problem if there's, significant disparity of income in which the lower earning partner feels like they can't save, they can't keep up, and then they blame themselves. I've often heard from, obviously I don't work with couples myself, but I've interviewed a number of financial planners who told me that it can become a sort of self-blame thing. Like, oh, I'm bad with money. It's like, no, you're not bad with money. You're just like contributing 50% when, your income is that much lower. And also take into account that if you get together with someone who makes a lot more money than you, it is much more likely that your lifestyle will adapt to theirs than vice versa.
Right.
And so you're effectively kind of unwittingly living outside your means. And also, even if with, a lot of people find that it works well when they actually contribute proportionally to their income, to expenses and to shared savings. Some people have strong feelings, I've found, about contributing 50-50 to certain things, like the mortgage. Like they really feel like as if contributing 50-50 sort of ascertain their that they own 50% of the house, which is in fact, like you own 50%. If you live together and you bought it together, you own 50% and you're entitled. It doesn't matter who's paying the mortgage. You're just as entitled to the house. The ownership stake really doesn't have any relationship to how much of the mortgage you're paying. But I think psychologically that's very important for some people. But I want to say, like, even if you were making, you're earning exactly the same amount as your partner, the 50-50 split can become problematic. Especially in a heterosexual couple, women often work fewer years. Like they take more time off. when they have kids. And then later in life, they also tend to take more time off to be caregivers for, elderly parents. And so you have to be careful, and it's something that you have to constantly revisit of whether the setup that you have of how you divide expenses is equitable, because equal doesn't necessarily mean equitable. That goes also, I've also seen this happen with disability, when someone had to go on disability and their income dropped, and the couple stuck to the same arrangement that they had before, and lo and behold, this person wasn't able to put money into their TFSA or RSPs anymore. So it's kind of an ongoing conversation about what is equitable.
Very interesting. So Erica, what are some signs of an unhealthy financial relationship between partners?
So the classic signs, I would say, are lies and secrecy. So telling, outright lies about what's going on financially, or withholding information. So that seems pretty obvious, but the red flags in a dysfunctional sort of financial relationship in a couple can be more subtle than a lot of people think. Especially what's really delicate is it will often be the case in a couple that someone is into managing the money and the other partner is not. It is like, it does make sense in a lot of cases for one person to kind of be in the admin, right? But admin is fine as long as you check in regularly with the other person. There should be no, there should be no like, I make decisions for everybody because I know what's best and I don't need to consult you, or I don't need to keep you informed. And so this is a generalization, and I have certainly seen the opposite as well, but in most cases, what you see in cases that then sort of, can become very problematic is men, right? Like, it's traditionally, that's the role. They take charge of the family finances. And then you can end up with two problems. So one is, and this you see more, I've heard many financial advisors tell me that when they work with elderly couples, especially women who become widows, it's like the past generation, the husband has been in charge of the finances for decades and they've never been involved. And now the spouse is out of the picture and they don't have any idea how to manage their finances or even what the assets and liabilities of the households are. At the other, and sometimes there was like no ill intention. It's just like how things used to be set up. And, and then it becomes a problem, when the spouse who used to be in charge is no longer around. And sometimes this can really lead to something that's called financial abuse, which is still where we really don't have nearly enough awareness of in Canada. Financial abuse tend to be part and parcel of abusive relationships because it's all about control. And if you control money, you can exercise controlling money is part of exercising control over someone else's life. And so you'll see often one partner saying, well, I don't like, I'm not good at money. I don't like, to be involved in this stuff. You do it. And then this can open the door to abusive behavior with the other spouse, hiding assets, concealing liabilities, concealing debt that they're taking on. At the, in the extreme cases that I've reported on, these are cases of, domestic abuse, not always involving violence, but you can get to the point where I've seen abusive partners like forbidding. Again, I've seen it with women doing it, but the vast majority tends to be men as far as the statistics that we have, where, they'll forbid the woman from going to school. or working. So she has no income. She has no credit card of her own. Her name will be, she's added on the husband's credit card. So she has no credit history of her own. There will be maybe a joint account, and then the husband will have several accounts, but the woman has no account of her own. And then at one point, the woman recognizes, maybe the relationship becomes abusive, maybe it becomes violent at some point, and then it becomes very, very difficult to leave that relationship because you don't have a job, you don't have a bank account, you don't have a credit history. You can't even get a place to rent these days without a credit history,
Wow.
without a good credit score. So it's something to, again, there are extremes. There are things that, seem obvious, but I have also seen some women who realized only when there was a separation and a divorce that, oh my goodness, my finances are in shambles. And all these years, I didn't realize. And it makes it that much difficult to rebuild after.
You touched earlier on having an emergency savings bucket. How much do you think people should keep in their emergency fund?
So yes, and it's funny because when I started out as a personal finance reporter almost like 7 years ago. I remember there was so much advice going around saying, who needs an emergency fund? You're okay with just a line of credit. Now the interest rates have gone up so much, and lines of credit have variable interest rates. And now that we have gone through the pandemic, I think the shock, those shocking months of like the spring of 2020, there's been a much wider recognition that yes, no, it's a really great idea to have some cash set aside for emergencies. So the typical rule in personal finance that you hear all the time is, have between 3 and 6 months worth of living expenses set aside.
Yep.
Now, I find that often can be daunting for a lot of people, especially like very young people just starting out in the labor market. So I would say if you're like a total beginner, especially if you're very young and just starting out, start with a goal that seems achievable. So maybe start with 1 month of rent. That's another rule that I've heard several times. It makes a lot of sense. Work your way up from there. Don't stop there. But as a first target, that makes sense to me. But then for myself, I feel like I use a slightly different rule and different process that I think can help a lot of people gauge, because I feel like how much you need to set aside really depends on your situation. And so take a look at, for example, if you were to be laid off, would you have access to EI? Would you have, how much severance would you be entitled to? That often is a function of how long you've been at the company. So I would argue, for example, that if you've just taken on a new job or if you're thinking about switching jobs, I would always beef up your emergency fund because you're going to have less severance if you ever are going to be laid off shortly after being hired, which we're seeing happening, for example, with the tech layoffs right now. And then I think it's also a matter of like what industry you're in. So, for example, as a journalist, it's a bit of a blood sport to find a job in a newsroom. It can take a really long time. So, if you lose your job, like how long, will you be unemployed? That also depends on the economy, but it really varies a lot on the industry. So for me, I put it at like maybe I'd like to be able to get by at least for 8 to 9 months. But it's not like I have that much set aside because right now I would have severance, I would have VI. But I also know that as a journalist, I would be able to earn some income as freelancing. So probably not replace the income that I have as an employee, but I sort of I sort of set out a worst case scenario that is plausible and then try to figure out like what is the difference that I wouldn't be able to make up and try to save up towards that. That's how I do it.
What do people need to understand about the different types of consumer debt products like credit cards, lines of credit, student loans?
Yeah, so that's the second part of trying to resist these bigger trends that push us all towards borrowing too much. So yes, you need to understand human psychology and yourself, but you also really need to understand debt. Debt is not created equal. There are many different ways of borrowing, and becoming a bit of a debt connoisseur will help you borrow wisely, because there's some, there's some strains of personal finance that are all about like avoid debts at all costs. And I find that that's really just not realistic in the world we live in. You're gonna have to borrow to buy a house if you get to buy a house. Very likely you've had to borrow to finance your education. And frankly, without borrowing, you're not going to have a credit history and a credit score, which these days are becoming just essential. Again, if you want, here in Toronto and even in a lot of smaller towns across Ontario, I just spoke to undergrads who tell me that they need to have a credit history in order to be able to find a room in a shared apartment. That landlords are demanding credit scores from 20-year-olds because it's so competitive. So how do you, borrow wisely? So in the book, I go over some of the, most common types of debt and sort of the various things that are useful for and things that people should watch out for. And so, credit cards are an obvious one. Everybody, they have a really bad rap. Everyone knows their credit card debt is expensive. But it's really helpful, I think, to think about credit cards and psychology. Again, going back to behavioral economics, we know that the human brain tends to worry less about negative things that are going to happen in the future. And so we also know that we tend to process paying for things as painful, emotionally painful, not physically painful, but the sort of the parts of our brains that light up when we pay for something are very similar to the parts of the brain that light up when we experience emotional distress. And so what credit cards do, one way and why they're tricky for a lot of people, is that they allow you to have the immediate gratification of buying something right now, but they decouple that from the emotional pain that comes from paying. So that's very important for people to keep in mind when they use credit cards.
Yep.
Lines of credit do pretty much the same. They're often thought of as sort of a benign version, and like they're also revolving credit. They work very similar to a line of credit. And a lot of the time, people emphasize the fact that lines of credit have much lower interest rates than credit cards, but you can also borrow that much more with a line of credit. So when you speak to licensed insolvency trustees and they talk about sort of some of the craziest cases that they've seen, it often involves a line of credit, or even more like a home equity line of credit that's backed by the equity in your house. And that's when people really can pile on massive amounts of debt, and then it becomes very difficult to get out of it. And also there are, a number of surveys, including one done by the FCAC, the Financial Consumer Agency of Canada, that found out, this was a few years ago, so maybe now people have caught up a bit, but I think it was 2016, and it found that lots of people didn't know that lines of credit were callable loans. Where the bank can change the terms of a line of credit, and people sometimes dismiss it as like, oh, it will never happen. Like I've seen it happen. I haven't been a personal finance report. Like I've been around for 7 years, which is like, as a personal finance reporter, which is like some time, but not like decades. And I've seen it happen twice, like 2 cycles of banks calling out some borrowers and be like, no, like you need to pay more than the minimum payment or like tweaking the terms of lines of credit. And it tends to happen when things in the economy are starting to go south. So exactly the wrong time for borrowers. So there's all kinds of, auto loans are another huge debt trap for a lot of people. They used to be this like plain vanilla, like very straightforward financial product. And then after the financial crisis, we started seeing auto loans with longer and longer terms. What that does is it means people are going to be in a negative equity position for that much longer. And so you're in a negative equity position when what you owe on your loan is more than what your car is worth, it's common, when you buy a car because it's a depreciating asset. It tends to, lose about a third of its value in the first year that you drive it off the lot if you're buying new. So it's not unusual unless you put down like a really big down payment to be in a negative equity position for a couple of years. But a couple of years is fine. You're usually covered by insurance for, if your car is stolen or is declared a total loss in an accident. Often, it's easy to get coverage where you get back the value of the car, but you go beyond the first like 2 years, you get yourself a loan that's like 7-8 years long. And that means you're taking that much longer to pay off that loan. That means you're making much slower progress towards reducing what you owe. And that means you're going to be in a negative equity position for that much longer. So the thing is basically the pace at which I think to explain to people, how negative equity with a vehicle works, you kind of have to think about like the depreciation curve for a vehicle is like very steep at the very beginning, and then it flattens out. So vehicles lose most of their value at the very beginning, but then that depreciation rate really slows down. Whereas the pace at which you're paying off your loan stays the same. And so if you're paying off your loan slowly and taking 8 years, for example, versus the traditional 5 years, you're going to be many more years in a situation where if something happens to your car, you're going to owe more on it, than the car is worth. And if you trade in that vehicle, say maybe at the 5-year mark with an 8-year loan, and you get yourself another car, you're probably going to have a balance left over, and that balance is going to be tagged on to your next loan. And that's how you end up with some people who are, I've interviewed, for example, a single mom once who I believe she owed like $29,000 on a $16,000 secondhand car.
Wow.
So
yeah, that's crazy. On a similar, well, maybe similar line of the debt question, what do you think the downsides are of the buy now, pay later online micropayments that have popped up everywhere?
That was another interesting one in terms of human psychology and behavioral finance. I think at this point most people know what the new buy now, pay later is, but just in case, so the old-fashioned buy now, pay later was, get yourself a washing machine, and maybe you don't pay for a year, and then you start, payments after a certain period of time. And so the sort of financial innovation that really, it was already popular in Australia, but really took off in Canada during the pandemic when everyone was like stuck at home and shopping online, was buy now, pay later for online shopping and for very small purchases. So that, for example, I can get myself a $300 pair of shoes and, pay it off in 3 installments of $100 or 6 installments of $50. And so that's really tricky. So like proponents of buy now, pay later point out that a lot of the time you can just pay in installments without fees. You're not, unlike a credit card, there's no huge interest rate unless you miss payments. But buy now, pay later kind of does something, similar to what credit card does, right? Where it's like separates some of the paying
Yep.
from the purchase. And it also tends to focus your attention on, like, the brain tends to zero in on, like, oh, great, I can afford $100 this month. And then I don't have to worry about the $200 that's the rest of my purchase. And so I tend to evaluate, whether or not to buy the shoes based on whether I can fit $100 in my budget this month, rather than whether I should spend $300 on a pair of shoes to begin with. And the other danger that people have flagged is that this generates like a number of small payments for people. So if people use buy now, pay later over and over again, are they going to be able to keep track of the fact that, maybe now I'm spending, I have 3 payments of $100 for the shoes, but maybe last month I signed up to buy myself headphones and already have, $50 coming out of my account for the headphones. Because also, we know that we have a hard time keeping track of small payments. And I find that a lot more of people's spending these days consists of microtransactions. It's not just buy now, pay later, it's also subscriptions. Everything is becoming a subscription. And then you have this like $3, $4, $5 charges that are really starting to add up. And it's very difficult to keep up. And people underestimate all the time what they're spending through small transactions.
That's a great point. I have a mortgage question for you. A lot of people go mortgage shopping and solely focus on the interest rate. What's the downside to that?
Yeah, I have to say that already was kind of a step forward, because again, when I started, I guess like this was like more than seven years ago. It was more like 14 years ago. I was an economics reporter, but still kind of looking at these things. And I remember the conversations about just people going to the parents' bank and just getting the first thing that the bank would come up with in terms of interest rate.
Yep.
And then I have to say Canadians have become much more discerning, and a lot more people know to shop around for the best interest rate. But I have to say, like, a hyper focus on the interest rate has landed people in with the wrong mortgage. And I've seen that a number of times. So some of the other things to consider if you're shopping around for a mortgage is penalties. So in particular, the penalty that you're going to have to pay to your lender if you need to break your mortgage. For example, if you need to get out of your mortgage before your term is up. That is something that I think a lot of people tend to not think about, not worry about, but we know, like, I've spoken to countless mortgage brokers who tell me life happens much more often than people think, and having to break your mortgage is actually pretty common.
Wow, really?
And that's where people have to be really careful, because mortgage penalties can be in the tens of thousands of dollars. And we saw that at the beginning of the pandemic. I don't know if you guys remember, there were some headlines of some borrowers got landed with $30,000. Like, there was one case of someone who had to pay $30,000 in mortgage penalties. So the mortgage penalty is meant to sort of make your lender whole, because you're, getting out of the loan sooner, right? Like you're gonna, you're gonna stop the repayments. You're gonna go maybe with another lender, or they're not gonna earn the interest on that loan that they expected. So that's why the penalty. But the question is, how is that penalty calculated? And as a lot of people know, variable rate mortgages have more flexibility and much lower penalties often than fixed rate mortgages. So generally it's 3 months worth of interest. So you look at the amount that you have left on your balance, and then the interest rate, and then you multiply by 3 months, and then that's usually what you're going to have to pay. That is sometimes the rule even for fixed rate mortgages, but if you go fixed, it really matters who you're borrowing from. And that's where the big banks and some credit unions use a complicated formula that it can result in extraordinarily high penalties. All of the big banks, as my last reporting, were doing this, and some credit unions. And so if you want to go fixed, it really pays to look for a lender that will apply a fair penalty if you have to break your fixed rate mortgages. There's sort of like a lot of people at this point have learned that there's flexibility with variable rate mortgages, but I find that there still is sort of limited awareness that you don't have to go variable in order to have flexibility. There's definitely a lot of competitive offers out there where you can sign up, often with a monoline lender who focuses only on mortgages, or some competitive credit unions. You're going to be able to get out of your fixed rate mortgage with a very reasonable penalty, and without the need to go variable, which has also caused a lot of trouble and lost sleep for a lot of people recently.
Yeah, it's such a common one though for people to go to a big bank and look for the lowest possible rate.
I mean, if people really are really want to go with the bank, and it happens to be a big bank, at the very least shop around, see what else you might get a serious offer from another competitive lender, and then take it to your bank and see if they'll match it. But be aware that if you go fixed with a big bank, mind the penalty.
Right.
What do you think about independent mortgage broker versus going to a bank?
It depends. I've used it depends on the mortgage broker. So mortgage brokers, as in every profession, can be very good and really guide you through and show you, sort of have a, they can find sort of the most competitive offer that really fits your needs, and they can ask all the right questions and really help you land on the best possible mortgage product available to you. But I've also seen some mortgage brokers who didn't even realize that their clients didn't have a credit history.
Yep.
There's a lot of variety out there, which is very unhelpful for someone who doesn't know where to start. I realize. I think, do a lot of research.
That is a tough one though.
It's a tough one. It really is a tough one. I have a list of sort of questions to ask a mortgage broker in my book, and sort of that's the best to really read up on how to gauge how qualified the mortgage broker you're sitting in front of is. I've also had very mixed experiences.
Yeah, that's interesting. I didn't really think that. Of course, it makes sense. I just wasn't thinking about that because I've been lucky enough that we have a very good mortgage broker that we refer clients to, and so I just went to her and it was super easy. But of course, that's not going to be everybody's experience.
No, yeah, it can vary.
Yeah. What do you think people need to understand about credit scores?
So that's another huge one, and it's one of the sort of top 10 questions of personal finance, I would say, right? Like, it's super important to understand credit scores, but so few people really understand how they work. And so, everybody knows that they're important and that you need a good credit score to be able to borrow at lower rates. And that's kind of about it in terms of the common understanding. And it's easy to understand why there's so much confusion, because it is a complicated product. It's opaque, right? By design. Credit bureaus cannot explain exactly how the sausage is made. And that makes it difficult for people to explain how they work. And so I find that very common misconceptions about credit scores are, especially among young people, there's this assumption that you start with a perfect score and then you kind of lose points, if you make the wrong decisions. It's a point system. And then the other very common misconception is that there is a secret formula to improving your score, that like there's like very specific maneuvers that you can make financially that will improve your score. And in fact, I find that it's really, for me specifically, like I found it really helpful to think about insurance when I think about credit scores, because they're very different product, but there are significant similarities. Like a credit score is a gauge of your riskiness as a borrower. So lenders want to know, what are the chances that you're going to repay what you owe in full and on time? And insurance kind of does the same. Like it's like insurance relies on a gauge or an estimate of how risky you are likely to be, your behavior is likely to be, based on data points that they've collected from often millions of other people's and other behaviors, right? And so that is why, so for example, that explains very well why you need to have a borrowing history in order to have a credit score. When you're starting out, you've never borrowed before, you don't have a perfect score. You are a total unknown quantity for lenders. And that's why the longer you've been borrowing, generally, like that helps your credit score. Like a long history of low risk borrower behavior helps your credit score. The same way that a new driver will be considered very risky by auto insurance companies, as opposed to someone who's been behind the wheel and had no or very few accidents over decades. Right. So I find that really helps. And the other thing is like really the same, it's very interesting. So I asked in the book, I asked Julie Kuzmic at Equifax. She's sort of in charge of, or has been in charge for a long time of dealing with consumer issues. I was like, can you explain the best possible way how credit scores work? And one of the points that she made is, people should be very skeptical of overly specific advice about how to quote unquote fix your score, because the very same action done by two borrowers who have a different credit profile can have very different impacts on their score. So for example, take someone who takes out a new credit card. If this is someone who, the algorithm already knows has some debts in collection, taking on new debt, it's like the algorithm goes like, uh-oh, this is a bad sign, and it will probably hurt your score. Or it might, I shouldn't say probably, it might, depends. But if you're someone who has a long history of paying everything in full and on time, and your credit score is already high, the fact that you're taking on a new credit card might not affect your credit score at all. And so when you hear, there's like a lot of advice online. This is also something that's it's actually there are products, right, that are marketed as credit repair loans. And the whole marketing spiel is take on this loan, start making payments, and this will help your score. And then when you look in the fine print, it says there's actually no guarantee that this will help your score, because if your score is already bruised and you're borrowing more money, who knows?
Wow.
It might actually hurt your score in the short term that you're taking on more debt. So be very skeptical. Like really the only generalizations about how to improve your score and maintain a good credit score is, you have to borrow, which is counterintuitive for a lot of people, but you have just make your payments in full and on time all the time. And then the only other thing that can be said is generally a little bit of variety in the ways that you're borrowing. So, having some revolving credit, like a line of credit or a credit card, and maybe an installment loan, a mortgage, a little bit, that generally helps. But anything that starts to get like, this is how much you need to borrow, or how much of your credit card you need to, how much you can borrow against your credit card, or you need to have an auto loan and a mortgage and, an installment loan. Just like, no. Always be skeptical of that stuff.
Let's shift to housing for a bit. How do you think people should approach their rent versus buy decision?
Yeah, so that's become really the impossible question of personal finance in Canada, hasn't it? So I've revised sort of my answers of this question over the years, and here's where it stands now. So I gave people a process for thinking it through. And this is generally a response that, holds for someone who is young, who is sort of wondering about, will I be a forever renter, or should I really try to get into the housing market? And who doesn't have sort of unlimited financial resources. So I would say the first thing to think about is, what is your time horizon? Okay, especially if you're young, like how settled and committed are you to the place you're living in right now? Because if you think that there's a chance you're going to be moving in the next 5 years, then I'd say automatically the answer is rent, don't buy. Because even if you have the opportunity to buy, the transaction costs involved in buying and selling real estate are so high that no matter what happens to housing prices, like forgetting the fact that right now they're stagnating or declining in most of the country, like even if the appreciation is crazy, in that short a time, transaction costs are just going to eat up so much of it. And then I would say it's a really good exercise to do a little bit of the math of renting versus buying. And I really like sort of the 5% rule that Ben has been talking about through the years, which is sort of, and the 5% rule is really all about comparing the unrecoverable costs of owning a home to renting, because there's like this common idea that renting is throwing money out the window, right? Like you're just paying money to the landlord and you're not building equity. But people often forget that owning a home, there's all kinds of ownership costs, all kinds of things that are not going to build equity. The rent, the interest you're paying on your mortgage, the property taxes, the inevitable repairs and maintenance costs. And even the cost opportunity of parking a lot of your money into a real estate asset versus investing it somewhere else in the financial market. That's all things that need to be considered. And so I really like the 5% rule, because it forces people to think about these things and think about the unrecoverable costs of owning a home. And then, the 5% rule, probably Ben should explain it, but it generally boils down to look at two comparable homes in the place where you want to live, and say like it's a 2-bedroom apartment, look at the yearly rent for that apartment, and then look at the market value of a similar home in the same market, if the yearly rent is equal to or less than 5% of the market value of that similar home, then renting is a financially attractive proposition.
Yep.
Then there's all kinds of caveats and assumptions baked into the 5% rule, which especially right now when we're in a period of high inflation, high interest rates, you might want to look at those assumptions. But as an exercise, I find it's very, very useful. However, I find that often, even people who really stress the fact that there is nothing wrong with renting tend to stop at that, right? It's like, oh, you can be a wealthy renter, just make sure that you're saving regularly and that you're, investing your money, in the financial markets with a well-diversified portfolio, long-term investing strategy, and you can build your wealth. Owning a real estate asset is not the only way to build wealth, which I'm like, yes, 100%. But let's not forget that the other thing that people need to look at is rent versus their own income. And right now, rents are so high that a lot of people risk ending up being forever renters and not being able to set aside nearly enough for retirement. So that's really the debt trap. Like, if it, even if you decide I'm going to rent, like, you have to be able to save as a renter. If you can't save, then you really have to move on to some sort of larger life questions of, can I live where I am? That's a lot of young people right now are facing this dilemma of, can I afford to live in a big city? And, maybe the answer is move to a lower cost city or town, which again is also becoming in and of itself challenging, because even in smaller towns, at least here in Southern Ontario, rents are crazy. Or maybe the choice is, do I need to switch to a higher earning career? And these can be, like, I don't want to minimize these choices. These choices can be very difficult for some people, but I think that it is important for people to face them, because the last thing you want to do is, a few years down the line, you're facing the same choice, except you're broke.
Yeah. I want to keep going on that idea. How do you think the traditional sense of getting a good job with sufficient income for your lifestyle, how do you think that's changed over the last, I don't know, 50 years?
Well, I think it's really changed. And I think, again, like, it's interesting, as personal finance sometimes has this like hangovers from a bygone era, right? And I think still, when people talk about jobs, there's still this idea of the good job being sort of usually a salary job with good benefits and job security, which by all means, it's still coveted. It's still a good thing. But I mean, salary jobs aren't necessarily all they're cracked up to be. Can have a low wage, and maybe your benefits are not worth it. Maybe your job security isn't all you think it is. And maybe you'd be, earning a lot more and having a much more fulfilling career as a freelancer. And I find that even gigs, which are always sort of thought of as, a terrible way to make a living, and often are, but sometimes like gig can be useful in certain cases. And so I really argue that, work is work is work. And don't be so caught up, don't get caught up too much in the sort of stable job versus freelancing versus gigs. Just like the real focus should be in making sure that however you're working, you're getting your work's worth. And so in order to help people gauge that, like, I find like the first step is to estimate your actual net pay, which sounds obvious if you're getting a paycheck, but I would argue that it isn't, even if you're getting a paycheck. And by, your net pay, I'm like, look at, the classic mistakes that people who begin freelancing make is they underestimate their taxes, or they don't even calculate the taxes. So that's number one, and that's obvious. But obviously, if you get a paycheck, you don't have that issue. But another thing that can really trip people up is, like, think about, maybe you have you're getting a paycheck, you have a stable job, but if you're spending 4 hours per day commuting, I would argue that it's time, that is linked to your work. And I think your net pay, like, you should include that into your net pay when you're trying to figure out how much time comes out of your day for work and what are you getting in return. And that can also be very tricky if you're juggling multiple gigs, or if you're a freelancer, you have to account for dead time, like the time that you're sitting in an Uber, waiting for the next client, the time saying if you're, giving language classes that you are moving from, one of your students to the next house, that all is time in which it's not free time, right? And so I would count it towards your net pay. And then I also give people sort of, there's a little formula in the book it's a kind of a back of the napkin formula, but it's a helpful starting point. If you're thinking of going freelance, how much would you have to earn per hour to have sort of the same earnings, net earnings, and the same, if you want to take the same time off as your current, full-time job? And often, you have to be earning quite a bit more as a freelancer for the same sort of comparable financial outcome. And then when it comes to gigs, I really, so I'm not a fan of hustle culture and this idea that it's great, I can't make enough money, for the kind of lifestyle that I want with one job, so I'll just have two jobs. I find that over the long term leads to often misery and burnout. But gigs can be useful. Certainly, they can be useful in a financial emergency. It's just some income that comes in. And if you have to be careful with gigs about what are the entry level costs. Like even becoming an Uber driver, I looked into it once and I was like shocked. I should say Uber. I should say, any kind of
Right, sure.
drive share service. There are often like significant upstart costs, but if you can pick up a gig that doesn't cost you very much, and that's like a quick, income supplement in an emergency, that can be very, very useful. And then I find that gigs can also be a really smart way to explore a different career. Like if you're not happy in your job and you're thinking, maybe I want to do something else, you can start maybe doing it part-time as a side gig. And then you can really, first of all, figure out if that's really what you want to do, because it can be hard to tell. And then, if you're already, maybe you're in your 30s or 40s with a family and all kinds of financial commitments, it can be really difficult and financially risky to switch careers. But a gig, something that you start to do on the side and then grow, can be a sort of like low risk way of gradually transitioning. And then sort of once you then, I've interviewed a few people who've done it, like they started doing something else and then they liked that something else very much. And then they sort of gradually grew the side gig so that, after when they finally moved full time to what used to be their side gig, they were already quite established. And so they weren't all of a sudden abandoning a career in which they were established and then starting from zero. So I find that can be really useful. And then the other thing is, if you have a hobby that you can monetize, that can be great. Can be a way of reaching some of your financial goals faster. The only thing though is, I've seen this happen many times, where it starts out as a fun hobby and then people get really stressed out about it. And so maybe you're like baking on the side and then you're successful. And then it used to be something that you would do maybe in the evening after work to relax. And now you have, 10 cakes that you need to make by Friday.
That's a thing. There's a name for that. I don't remember what it is.
The E-Myth.
The E-Myth?
The E-Myth. Michael Gerber's, I think it's Michael Gerber's book.
Okay.
Yeah. You have a passion for a product like baking, and then it ends up kind of ruining your life because you got to keep making all these pies.
I didn't know that. I'm going to have to look it up.
Yeah. Classic book. So how would you explain the risk of investing in stocks to one of your readers?
So I generally do two things. So I talk about risk and reward to explain sort of why stocks have a higher expected return generally than, maybe other investments like bonds. So generally I start with, okay, stock versus bond. And I say, with the stock, you're kind of like a mini share owner of the company. And so you are participating in, the risk that that enterprise takes on, and it can be very successful, or maybe it doesn't. If you're, when with a bond, it's, you're a lender, like you're lending some money, you're going to get it back. The risk is lower. The reward is likely going to be lower too. And then the other thing that I tend to tell people about stocks is that, volatility. And so, if you look at it, obviously, it's the classic line of the stock market, right? Like it moves up and down a lot in the short term. Over the long term, it trends up. And then bonds, like maybe a line that doesn't move quite so much. And that can be helpful in helping people also understand, like, why you may need to readjust your asset allocation as you get closer to needing to take money out of your portfolio, right? Because you don't want to have to guess. So, that crazy line that's going up and down in the short term is going to be up, or is it going to be down when I have to take money out? So that's kind of how I tend to approach it.
How do you think people should, we've talked about behavioral economics a few times. How do you think people should prioritize the math of a financial decision versus the psychology?
So it's a really interesting question. And I would say the classic case when it comes up is a debt repayment and the sort of snowball versus avalanche model. So snowball being where you start with the, if you have multiple debts, start with the smallest one and pay it off, and then work your way up to bigger and bigger debts, which is very popular. And then the avalanche model, which is like, prioritize your most expensive debt and then work your way down to your least expensive debt. And so the avalanche model is the one that makes the most sense mathematically, because it will save you the most in interest costs. But a lot of personal finance planners I've spoken to and credit counselors swear by the snowball method, because they say it tends to work better in terms of psychology, because people who may be demoralized that they have ended up with so much debt and doubting themselves are able to pay off one of their debts and get sort of that's a psychological victory, right? It gives them a little bit of momentum and confidence to keep going. There are studies, there's one study in particular who found that the psychological effects of the snowball method didn't really pan out in their sort of study. My best guess is that perhaps the snowball method doesn't work that well if someone is working on their own versus working with a professional who encourages them and keeps them going. So that may be it. But my ultimate take on math versus psychology is, I would say psychology trumps math in the end, because if you can't stick to it, then it's going to cost you anyways. Just do what works, even if it's not the mathematically optimal, solution. But sometimes you may be able to find a solution that works well with psychology and still, that takes the best of both.
Right.
Our final question, Erica, how do you define success in your life?
That is not a personal finance question. I would say personally, my sort of guiding light has been avoiding regrets. So I really want to make sure that at one point I will turn back and be happy with the decisions that I've made, and also know that I gave it my all and didn't hold back. And so I, periodically look back and assess And that's how I try to define success. That and the no regret life is my is my goal, and I think it's been proven very useful. And then like what I can control, and the rest is sera.
Right.
Good answer. So other than the statement no regrets, Dan Pink, who's an author that we have coming up in a few weeks, would agree. He doesn't agree with saying no regrets, but he does agree on understanding what people will regret in the future and using that to guide what a good life is. Anyway, it's a great answer to the question, Erica.
Thank you. And then that there's also Shannon Lee Simmons just came out with a book, No Regret Decisions. I haven't read it yet, but
oh no, Dan Pink's going to disagree with her, at least on the premise of the title. All right, thanks, Erica. This was great.